Hey, what's up guys? Today I'm going to be making a video about liquidity. I'm going to basically go over all the basics on liquidity, what it is and how to use it, and my favorite draws on liquidity. Okay, let me explain what liquidity is. So liquidity is where a lot of stop losses and orders are sitting, and price usually gets drawn there because that's where the money is. Think of liquidity as like outstanding highs and lows where money lies. Let me show you guys. Here's an uptrend, here's a downtrend. So basically these highs, right, and these lows would be liquidity. And then same thing with the downtrend. These highs and these lows would be liquidity. And basically my point with this is that these highs and lows, they have money. Basically, what's happening is that that money is being taken. Just think about it like that. These are basically retail stop losses that basically market makers take out. So think about all these highs and lows as money being taken. Don't worry guys, I'm going to show you a bunch of examples and my favorite draws on liquidity. But before that, so why does liquidity matter? The market is just not moving randomly. It often moves to either grab stops, fill big orders, trap traders, or reverse or continue. So where does liquidity usually sit? I basically ranked my most important draws on liquidity at the top to like the most like non-important draws on liquidity to me. Obviously certain scenarios I prefer certain draws on liquidity, but on an overall basis this is what I would look for as the most important draws on liquidity. So for me, it's session highs or lows, whether it's a London or Asia high or low, PM high or low if I'm trading after 6 p.m. I also look at obvious swing highs and lows. My favorite ones are the hourly or the 4-hour. Another one is a data wick. A data wick is basically like a news candle. You know, a lot of volume kicks in and then we get a crazy wick, and usually price is drawn to that wick. Another one is equal highs and lows. It's where the market perfectly comes to a certain point. You know it's important because if the market passed on so much time and came to an exact point at a tick, clearly that level is important. Another smaller one and another draw on liquidity for me is wickless candles, when a candle has no wicks. And another one is, I don't use this that often, trendline liquidity. It's basically like low resistance liquidity run. I don't use it that often, but it's also good. But yeah, like I said, to me the most important are at the top, least important are at the bottom. It's just based on the way I trade and what I prefer. Obviously some people consider low resistance liquidity an A+ setup for them with an inverse fair value. You know, whichever way they trade, they trade. The way trading is that you're supposed to use your own data and what works for you, and you want to just replicate that. And that's what makes a good trader. If you're able to spot what you like to see all the time in the market and you're able to, you know, place trades with a good risk and reward, you'll come out with a lot of money. So yeah, let me just show you guys examples of these. Let me explain them. Before we get into that, I want to explain to you guys what internal liquidity is and external liquidity is. So internal liquidity is just like small liquidity inside the range. They are still highs and lows, but they're the ones inside of the leg, so they're not as obvious. External liquidity are like the highs and lows that you are seeing that are super obvious. I'll show you guys an example real quick. So basically this high would be like a external liquidity, and then this would be like an internal liquidity because it's inside of the range and this is outside of the range. Here, I'll show you guys another example. External liquidity, and then this would be internal liquidity. Okay, so the first form of liquidity that I love the most is session highs and lows. I literally use this all the time. I think it's the most important because the market is always drawn to a session high or low. The way I know which high and low is a session high or low, I have this indicator. It's called ICT Kill Zones and Pivots TFO. I turn it on. If you guys want to see it, I'll show you. It's literally by trade for op. And you know, if we go on the 1 minute time frame, you'll see it. As you can see, the market is drawn to these highs and lows. You know, it's a great confluence to add to your trading. For me, I think it's the most important. It helps you know where the market is going. Look, the market is always drawn to either a, you know, Asia high, London high, PM low. You know, as you can see, it's super obvious that once we sweep a session high or low, we reverse. You can tell like money is being grabbed here. That's the most important thing about liquidity, is that you got to think about it as like money's being taken. But the way I like to look at liquidity is that, you know, a lot of people think, oh, look, we took out some money, right? So it's going to indicate a full reversal. I disagree with that, actually. As you can see, what's happening here is that we swept London, right? We come back and we retest sellers to come lower. My point with this is that most people like to look at it as a liquidity sweep, as like a reversal, but for me, it is really important if there's an SMT or not. If there's an SMT, okay, there's probably a high chance of reversal, but overall, whenever I see a liquidity sweep, I think about it as, oh, we're basically like faking out people. People are going to think, oh, we're reversing, but no, we're grabbing more sellers and continuing our direction. As you can see, New York PM, same thing. We dump, blah, blah, blah. We sweep, right? what happens? We come back, grab more sellers, and then we dump lower. You know, a lot of people don't look at the market this way, but this is literally how the market moves. The reason why a lot of your inverse fair value gaps fail is because you think we sweep liquidity and we're about to have a whole reversal, but the truth is that we're sweeping liquidity and we're retesting sellers. So you're trying to hold to the high, but the true direction is not the reversal. The true direction is just a continuation. And, you know, when I started looking at the market like this, it's made it so much more clear. Another really important form of liquidity to me is an hourly or 4-hourly swing high or low. And these are just honestly obvious highs that you see. This would be a draw on liquidity. This would be a draw on liquidity. This would be a draw on liquidity. And you know, as you can see, when we swept this, what happened? We had a full reversal. If you were to look at ES, there's probably an SMT here, which is why we probably had it. We have a liquidity sweep right here, and then what happens? We retest sellers, and then we deliver lower. Here, look, I'm on the hourly now too. For example, boom. We sweep liquidity, and then we have a reversal. Or for example, we sweep liquidity here, and then we have a full-on reversal. It's basically just like the outstanding highs and lows, if that makes sense. And remember, there's just money that lies here. You know, we're taking out money. Boom, liquidity sweep. It's like so obvious that there was money there that we had a whole reversal, you know? All these highs and lows are examples of liquidity. You know, people overcomplicate liquidity. It's literally just highs and lows. Everything is liquidity, but you have to understand what is the most important liquidity you're looking for and why it matters to your trade. But yeah, like I said, I like the hourly and 4-hourly swing highs and lows because it shows me where the market's going, or if it's reacting with an SMT, I'll understand if it's a reversal or if we're just going to retest sellers or buyers to continue the move. Okay, another really important draw on liquidity for me is a data wick. What is a data wick? It's a news candle. Why is this important? It's because there's a lot of volume, which means that the market is usually drawn to it. This is a really important draw on liquidity, even though it's third. Once you set a data wick, it's like a high priority draw on liquidity. Like, you'll see the market get drawn to it very quickly. Let me show you guys an example. You'll be able to tell by having the volume indicator on what's like a high volume candle. Not every single high volume candle is a data wick. You also have to look at on forexfactory.com. Basically, anything that's like red folder with USD is going to tell you that there's a high chance you're going to get a data wick there. Let me find one for you guys. Okay, I found an example right here. So this was a New York PM high, right? And as you can see, during this time, if you grab the measuring tool, we went up about 130 points in the span of like a minute. That shows you that a lot of volume kicked in, and there was definitely something being said which influenced the market to move like that. And what you would do is you would mark this high. That would be a data wick. Look, literally as soon as PM session opened, look, this candle was super important, as you can see. The market eventually was drawn to it. And yeah, basically a data wick can have two sides, right? So let's say this is a candle. A data wick can have a data high and a data low. And you need outstanding wicks because that shows you that it's going to be an obvious draw on liquidity. How do you know which one we're going to be drawn to first if you have two outstanding wicks? You don't. You would pair it with your bias and all your other confluences, but if you didn't have that, you would honestly just wait for one of them to get swept, collect the money like I told you guys, and then you would understand that the next one would be the data low. Hold up, let me show you guys better examples. Here's a better example. Boom, 8:30, we had core PPI, red folder USD. As you can see, in a span of a minute, we move around 80 points. But basically, you can tell that the volume on this candle is high. This would also be an example of a data wick. Remember, we wait for one side to get swept. So now we know that the draw is this high. I can assume that the market's going to be drawn to this data high since we already swept the data low. And boom, you can just see we're going to eventually just go to that data high. It would be stupid to look for shorts here because we know the draw is the data high. And even on this data candle, right, you can see that, oh, we swept the high. The only thing we're left with is the low. And we end up sweeping the low. Just because there isn't a red folder news doesn't mean that it can't be a data wick. The way you assume that there's a data wick is you see outstanding wicks, like big outstanding wicks. And the reason this is because Trump is president now. When he says something crazy, it does give you like a crazy data wick. And yeah, I think it's important to pay attention to that because you can be so on point with your bias and confluences, but if you miss a data wick, sometimes you can lose some trades. It's just a good way to prevent losing trades, you know? Another important draw on liquidity, not for me, I don't really use this that much, but equal highs and lows, the market's usually drawn to them. What is it? I'll show you. So an equal high or low is whenever you have the market literally moving and it perfectly touches to an exact point, and this would be an example of an equal high because the market was engineered to this exact price. So you know it's an important level that market can be drawn to. So this would be equal high, and then an example for equal low would be lows being exactly engineered to come to this exact price point. A lot of people think this is a very important draw on liquidity. I don't really pay attention to it as much, but it is important for sure. Because for me, I prioritize session highs and lows. I think that's the most important. Think about it like this. The market made a low, right? And after a span of like, let's say hours, we come back to that exact price point, exact to the tick. It shows you that it's an important level, and then price can be drawn to it. As you can see, the indicator shows me that this is an equal high. So, you know, I would understand that the market could be drawn to that high. And the distance between them is super important. I don't like when an equal high or low is so close to each other, because to me it doesn't mean that it's important. Because think about it like this. If you were to have an equal high or low and then a minute later it goes to that same exact price point, it doesn't really mean much because we're already around that area. But if you think about it, after a couple hours, after 65 minutes, 85 minutes, we come to that same exact price point, okay, it's really important because we did a bunch of bullshit, right? And then we came to that exact price point. So it's like the distance between it is super important to me, okay? It's super important. Because, here, let me see if I could find a very close one, for example. Here, this would be an example of a non-relative equal low for me, because look, we came to the exact price point in the span of, you know, like 5-10 minutes, right? And look, as you can see, we weren't really drawn to it. If it was so powerful, we would be drawn to it. Like I said, I like when it's super far apart. It makes it more high probability. Another important draw on liquidity for me is a wickless candle. A lot of people don't pay attention to this, but it is actually super important. Like imagine you were about to take a short or long, but then there was a wickless candle and it's the reason you failed a trade or you lost out on a trade. Let me show you guys how cool this is. So here, wickless candle, right? Look at how the market just comes up to go grab it. You know, the reason why it's so important is because just think about it like this. It's like an imbalance that needs to get filled. We need to wick there and grab those orders. Look, I can show you guys a bunch of examples. Look, boom, what happens? We take it out. Wickless candle. Look, we take it out. Here's another one. These are tiny, but look how they automatically just like, they get taken, you know? Like I said, this isn't as important. This is like more of a smaller thing. It just helps you lose less trades. But it's good to be aware of them. Okay, the last form of liquidity that I'm going to explain is trendline liquidity. And basically what it is that you have a trend, right? It's basically like these highs and lows, right? They're basically just like a bunch of stop losses, right? So when the market takes out one of the highs, it tends to take out all of them. It would be the same thing with an uptrend. These lows would basically be liquidity, right? So once we're taking out the stops here, you can expect the market to take the stops here and then take the stops here. Because remember, this is all just stop losses. It's all money. And you know what the market likes to do is once it takes out a high or low, it likes to take out all of these in a trend line. It's basically called LRLR. It's low resistance liquidity run. It's just sideways consolidation. Because, like, you know, consolidation is this, right? And, you know, at the end of the day, these highs and these lows are liquidity. LRLR is trendline liquidity, and it's just, it's sideways. Like, if the market tends to take one high, it ends up taking all of them. Here, let me show you guys an example. As you can see, we kind of developed this trend line, making all these lows on this line, right? Look, once we take out one low, what happens? We just fall and we take out the rest of the lows. And yeah, as you can see, when we take out one low, we tend to take out a bunch. Let me show you guys a bullish example. Here we go. You see, we generate these three highs, and what happens? Once we take out one high, we take out the second, and we take out the third. And what happens? We just take out all this money together. Trendline liquidity is an important draw on liquidity. I don't use it that often, but it adds confluence to my trade. Like I told you guys, most people look at a liquidity sweep as a reversal, but the way I see it is that you're sweeping liquidity and you're gathering more sellers or buyers to continue the direction. The only way I see a reversal most of the time is with an SMT. The reason why a lot of your inverse fair value gaps fail is because your draw on liquidity is usually wrong. You think because we swept some sort of liquidity, we're going to have a fat reversal, but in reality, we just sweep a high and low, pull back, and gather more buyers and sellers to continue the trend. The main point with this is draw on liquidity is the most important thing in trading. Your model and everything is also important, but if you don't know where the market is going, you won't know where to take your trades to. You will have no bias. If you guys want a video about which session highs and lows I look for to be taken, and how I trade them, get this video to 50 likes. But yeah, guys, like and subscribe for more content like this. Follow me on Instagram, Arion Trades, with a Z at the end. DM me if you have any questions. And yeah, see you guys later. Oh yeah, and comment the word sweep if you made it to the end of this video.